like there's drug structure activity relationships. I think there's deal structure activity relationships. I think the VC group panel covered a lot of these issues. You know, the valley of death. I think early stage stuff that's sort of pre-IND, but ready for pre-IND, I mean they've done the stuff. I find that attractive. We do preclinical deals. I think you're hearing from the whole panel. We're not afraid of preclinical deals. We're not afraid to chop up different regions. We're not afraid of the outside world. We very much, the scientists, I think, across organizations are very much into collaborations, and we know, based on the track record of larger companies, that internal R&D, no matter how big you are, can never be enough to carry your company's growth forward. So I think you have a pretty open-minded group. Jean-Michel, do you want to talk a little bit about sort of the next stage, you know, clinical proof of concept, phase 1B data? You know, the company's probably had a Series A, B investment. It looks safe and tolerable. You know, what I'm throwing down here is sort of what are possible deal structures at that stage, and that's usually a license, asset purchase, co-development. I mean, there's all kinds of flavors, you know, but is that sort of how you guys see it at that stage?
So I guess we need to separate the question between, let's say, in general versus a specific dry eye compounds.
Yeah.
I guess we are looking for compounds that are from preclinical, sometimes very early, to registration stage, and we're really trying to have a flexibility in the deal structure that what we can offer to our partner, and that can go from a licensing, from almost an MTA to a licensing, to a stage acquisition, to an upfront buyout, pretty much. Again, as I was mentioning, it's function of the perceived risk and the perceived stage of the science and the data that are there. The difficulty of dry eyes, we can often show safety. The major issues has been efficacy. And
Yep.
We've got many classes that went through a lot of molecules where you are able to find a dose which is safe and tolerated, but doesn't translate into the crossing the hurdle for potential efficacy.
Yeah.
So the early phase 1 safety is extremely difficult. That's my personal opinion. The really key data are the proof of concept data, where you start generating the key clinical element. Having markers that show that you are modulating the targets are very encouraging. At least it validates that the mechanism of action that you're postulating is there and is really working, or you are able to modulate that. But you still have to understand how much of that modulation translates into a clinical benefit.
Yep.
And that's where really collaborative situation can work the best, because large companies are able to put some money at risk, share and integrate really the appropriate clinical teams or the teams from the partner together to develop a plan that can work for both entities. And Alcon has been spending a lot of time trying to do that in terms of creating really a forum where you are part and we are part of the same group of people targeting the same goals. And we just bring some capital, and we just bring some know-how in terms of operationalizing those aspects up to the point where we can generate the appropriate data. And that can work best, but it's not an exit in the sense of the case. So we need to really make sure that the expectations are managed on both sides.
Okay, and we'll go to the next stage. Just see each of these stages. I sit on the buy side. I go through this a lot, and this is a dangerous stage for small companies. So this is where you've gone from beyond. We have nice preclinical data. We have a nice mechanism, maybe a biomarker. It's safe. Whatever. You can partner at that. You can get there usually with a reasonable investment, maybe, like I said, maybe Series A, Series B, or an angel round plus an A, and then you can sell. And we were talking earlier at the panel about the more money you raise, the bigger the deal has to be. So you can get negative returns even if you get a deal done because you've done 3-4 rounds. The problem with this phase, so at the phase 1B stage, the sky's the limit, right? Your drug hasn't burnt, hasn't gone down in flames. There's nothing going seriously bad. You have a lot of promise. Now, you're not going to get as much money for it because you don't have the efficacy question answered. If you go to phase 2, especially in dry eye, it's a tough area to go, and you go that far, and it doesn't turn out that good. The commercial side of a large organization now has put a ceiling on what this drug's potential is. And if you drive terms that are too high, you spent too much to get there, it starts getting harder for it to pencil for buy-side, because we're nervous too. So I think that's what I also call the real valley of death. And then, the next part is you're not getting what you want from the buy-side companies, and you really got to think through, hopefully before you do the phase 1B, what is your market? Who's going to be buying this? Where does this fit? Because I see a couple companies not getting the kind of deal they want done after talking to a lot of people, and then they're kind of off on their own to go commercialize, and that's not exactly what the investors were hoping for. Now, in the earlier days when the IPO market was functioning and that kind of thing, a lot of companies really strove to do that, build it and they will come take us out kind of mentality. But today, so that's going to be interesting to see how that plays out over time. There's a number of companies that are kind of going for the all-in bet to get to the commercialization stage, and we'll see how that works. I would like to reserve, do you guys have any comments? I'd like to reserve at least a minute, 20 seconds for a few questions. Sorry about that.
16.
Lot to cover here. So does the audience have any questions? You can raise your hand or shout or anything like that.